My name is Jake, welcome to the channel. In today's video, I want to talk about the Nasdaq and I want to break down what companies pay a dividend in the Nasdaq ETF, the QQQ. So we're not going to talk about the index as a whole, we're just going to talk about the ETF, QQQ. This is the more common ETF. If anybody ever talks about investing into the Nasdaq, they're usually talking about investing into the Qs, and that's what we're going to be talking about in this video. So this video is really for the die-hard dividend nerds. It's really more about, hey, did you know? And it's kind of one of those like head scratchers. Oh, that's cool. I didn't know about that. So I'm not going to teach you about discounted cash flows or dividend growth rates or anything like that. This is more of a video that's just like, oh, wow, that's actually kind of cool. I never thought about that, or I never saw that before, or heard of that before. So that's what this video is. Grab yourself some popcorn, sit back, relax. It's not one of those videos that you really have to take notes on. It's just more like, hey, this is all the research that I did. I thought it was pretty cool. And I thought, hey, you might like this as well. So let's sit down together and talk about it. So the Nasdaq, traditionally, when I think about the Nasdaq, and everybody has a different view on things. And when I think about the Nasdaq, I think about just pure growth and technology. And we're going to kind of debunk that. But actually, when looking at the QQQ ETF, 50% of the companies, 50% of the 100, so 50 of them pay a dividend and 50 do not. And actually 65% of the weighting in that ETF, in the QQQ, actually pay a dividend. And we're going to take a look at what companies pay a dividend and some of my personal favorites, and we'll talk about that. And then towards the end of the video, I'm going to kind of compare the dividend growth rates of QQQ, the Nasdaq ETF, the SPY, the S&P 500 ETF, and my personal favorite dividend growth ETF in the Schwab SCHD. So that's what we're going to talk about in today's video. So before we dive into that, if you're invested in the stock market, I'm sure you're seeing a lot of red days, a lot of green, well, not so many green days lately. You've seen a lot of red days, myself included. My portfolio's kind of hanging in there. It's going up and down and everything in between, going sideways. I think over the next couple of months, years, it's going to be more of a, sideways market, but who knows? The companies in my portfolio, so they're all different. Some of them are more skewed towards growth, like for example, Target, Costco, Walmart, Union Pacific, AbbVie, and then you have others like Procter & Gamble and, 3M, Coca-Cola, etc., that are more skewed towards value. And the portfolio is just kind of doing what it's supposed to do. It's generating cash flow, it's generating dividends every single month, and I'm reinvesting the dividends and I'm dollar cost averaging. But yeah, the market is down. There's a lot of turmoil in the market right now. It's kind of a weird time. I mean, I never thought in my lifetime I'd see $10 a gallon in gas. Thankfully here in Austin, Texas, we don't have that. I think we're like a little over 4.5. But could you imagine you're an American and you're going and you're paying $10 a gallon in gas? I mean, I shouldn't laugh because it's probably gonna, be that way here in Texas pretty soon. I don't know, but holy cow, this is not what I had in the cards for 2022. I did not see this coming, that we were going to get $10 a gallon in gas. And I'm just thinking to myself, what the heck? When I lived in Germany, I always thought Germany had the higher gas prices, and they do. In May, across Germany as an average, it's just under $9 a gallon to fill up your tank, fill up your gas tank in Germany. Almost $9. And here in the US, it's just under $5. So across the board. And I think that is so interesting that gas is almost double in Europe, in Germany. But yet here in America, we always complain about high gas prices. But I don't know, I'm just sitting here waiting until, those $10 gas prices come to Austin, Texas. And it's probably going to feel and look a little like this.
Yes, the news we're getting from the security services is that everything is fine here and back to normal. That's the latest. As you can see behind me, everything is now fine. Ignore the smoke, that's just from the recent explosion because, as I say, everything is fine now.
Can you tell us if there have been any fatalities?
Nobody's dying at the moment, everything's fine. There have been some recent deaths due to the major incident, but that's over now and everything's fine.
This is fine. I'm okay with the events that are unfolding currently.
Oh my gosh, everything's fine. Everything's fine. Have you caught yourself saying that? I know I have. Everything's fine. It's okay. Yeah. But when it comes to the gas prices, I'd be really curious. So here in Texas, in Austin, we pay about $4.60 for regular. Where are you at? What do you pay in gas? What does gas cost where you're at? So if you would, leave a comment below where you're located, where you live, either your state here if you're in the US, or if you're international. Let me know what you paid to fill up your tank, or what gas was per gallon. If you're in Europe and you use liters, times it by 3.8, and that's what it'll say. That's how you calculate it in gallons. But yeah, I'd be curious to hear how much you're paying in gas. Oh man. So anyways, all right, let's talk about the Nasdaq and some dividend stocks and all that good stuff. So I want to make sure that I preface this, that I'm not talking about Nasdaq, the entire index. So in the index, there are over 3,000 different companies in the index. I am just talking about this ETF, the QQQ from Invesco. And the way that this ETF is set up, it's market cap weighted, and it's based off of the 100 largest companies in the Nasdaq. So, and I guess just to make sure that everybody understands kind of how this ETF is set up, let me just kind of read this here for you. So per the rules of this index, talking about the methodology of the index, the fund only invests in non-financial stocks listed on the Nasdaq and effectively ignores all other sectors too, causing it to skew massively away from broad-based large portfolios. So it's not really looking at financials. There's no REITs in here. It's primarily focused on technology, biotech, and a few others. The QQQ has huge tech exposure, but it's not a tech fund. When I thought about that, when I think about the Qs, I always think about tech in a pure sense either. So the fund's arcane weighting rules further distance it from anything close to a plain vanilla. So plain vanilla, for everybody that maybe doesn't know that, vanilla is just plain, just basic, no crazy, components to it. It's just very broad-based. It's a pure tech play. The ETF is much more concentrated in its top holdings and is more volatile than other vanilla large cap benchmarks. So other large cap benchmarks would be like the Dow, the S&P 500, for example. Still, the fund has huge name recognition for the underlying index of the Nasdaq 100. So what it's saying here is skewed more towards growth. There's going to be a higher weighting towards the highest, allocated companies in here, and you'll see that right here. So the top weighted companies here, as you can see, this is really high. So over 12% in Apple, over 10% in Microsoft, 6% in Amazon, just under 4% in Tesla. Alphabet, Meta, there's two classes of Alphabet in here. You got Nvidia, PepsiCo, and Broadcom. So if you don't look under the hood and you just think, okay, the NASDAQ, you're just going to get technology stocks like cloud stocks. No, that's actually not the case. And just on this list here, the majority pay a dividend. Apple pays a dividend. Microsoft, Nvidia, Pepsi, Broadcom, they all pay a dividend. And the top weighting, this is actually really, really high. So what I just read there, it's showing it's more volatile because it's not broad-based like the S&P 500. It's more skewed towards, a handful of individual companies. And if you look at the long tail, so the long tail is further as you go down in the asset allocation, you can see here that, yeah, you're getting invested into to Workday and Dollar Tree, but just really small percentages, right? You got Electronic Arts, right? Battlefield, you got eBay, you got SiriusXM, you got Zscaler, etc., DocuSign, Okta. Like, what I thought? When I first thought about the NASDAQ, or when I thought about the Qs, I thought that this, like the Okta and DocuSign, would make up a significantly larger percentage of this, but in reality, they actually don't, and it's due to the market cap weighting of how this ETF is set up and the methodology behind it. All right, so before we compare the Qs, the S&P 500 and the Schwab SCHD ETF and the growth rates here, let's take a look at all dividend stocks that are in the Qs. Now, bear in mind, I did this all by hand, so it may not be perfect, but I had nothing better to do on a weekend than go and take a look at a list and create a pie with 50 dividend companies from a list. So yeah, that's what I do. Once again, as I mentioned, this is for your dividend nerds out there. Unfortunately, the performance here is not showing. I don't know why. For whatever reason, sometimes M1 Finance, the chart here is not working. So this is not working, which is unfortunate. I would have loved to see the historical performance. But nonetheless, you got 50 companies in here. And this was, I did this by hand, right? So I went in here and I confirmed every single one of them in Seeking Alpha. And that's how I got the 50 here. So I did this all by hand. This is, yeah, it's equally weighted here. There's 50 of them. These are some of the companies that pay a dividend that you probably didn't know, right? Did you know that Amgen was in the Qs, right? Do you know that Broadcom was? Maybe Broadcom because it's, more of a tech company. Cisco, yeah. Comcast. Now let's be honest here. Who knew that Comcast was in the Qs? I didn't. Who knew that Costco was in the QQQ ETF? I didn't. Who knew that eBay was? Or Honeywell? This one really shocked me. Honeywell is in the Qs. I thought it was interesting. And the one that shocked me probably the most, Kraft Heinz. Kraft Heinz is in the Qs. What? I don't know if Warren Buffett had a say on that or what, but Kraft Heinz, I kid you not, is in QQQ. This is also an interesting one. If you really like Oreos, I love Oreos. You can invest into Oreos by investing into QQQ because Mondelez, I think I'm pronouncing it right, is in QQQ. A few other ones that's interesting. Pepsi, one of my favorite dividend stocks, my top 10 favorite dividend stocks. Pepsi is in the QQQ. And this one, so Heinz, and this one surprised me the most. Ross Stores, Ross, is in the Nasdaq, the QQQ. Who would have guessed that? I had no idea. Starbucks is in here. I think this is, kind of surprising, kind of like with Pepsi. Texas Instruments is not surprising. Walgreens is in there, right? Absolutely interesting. But if we go back to here, you can see the sector allocation, right? So only a third of the companies in here are core, technology companies. Well, I guess I take that back. Electronic technology, technology services, I take that back. Over 50% are. You got retail though, healthcare, consumer services, durables, consumer non-durables, product, communication, and utility. So kind of interesting. The one thing that I thought was really kind of where I was scratching my head, like Sirius XM, right? Like why is Sirius XM in here? Okay, you got, XL Energy. Okay, interesting. But I thought that this was really interesting to see the different companies. Like, where is this? Cintas. Cintas is in the Qs. What? I don't know about you, but this really shocked me. I did not see this coming because, as a dividend investor, I don't really spend a lot of time researching, the Qs, the Nasdaq. I'm more focused on dividend growth, specific ETFs, or VGT. I really like the Vanguard Technology ETF, but I haven't spent a lot with the QQQ ETF. And so that was interesting. But if I break down my favorite dividend growth stocks, right? So I kind of went through that entire list. So the 50 that we just looked at, I broke down 7 of my favorite that I thought were pretty cool. So if you're interested in Nasdaq specific stocks for whatever reason, these were my favorite. And I'll leave a link to both of these pies in the description below. So if you want to see all of the dividend stocks that we just saw, the 50 and the 7 here, the link will be in the description below. Once again, the chart here is not working. I don't know why it's not working. Maybe it works in the future. It's weird. Sometimes it works, sometimes it doesn't. The 7 that my personal favorites, I don't invest into all of these, but my personal favorites in terms of dividend growth stocks in the QQQ, personal favorites, that I like Apple, I like Microsoft, I like Comcast, I like Costco, I do invest into Costco, I like Honeywell, I do invest into Honeywell, Mondelez, something, I don't know, don't laugh at me, Mondelez, sure. Really good. consumer staple. I really like Oreos. That's how I know them. And Pepsi. So Pepsi, really, really great. This really shocked me. I did not think that these type of companies would, well, obviously these ones, right? But I didn't think that these ones would be in the QQQ. But yeah, I thought that this was interesting. And, you know, maybe there's one or two of you out there watching that might find this kind of stuff interesting as well. I'm sure there's more dividend nerds out there than just myself. All right, now what I thought would be kind of cool is let's compare QQQ with the S&P 500 and SCHD. So the QQQ orange, S&P is blue, SCHD is a purple-ish color, purple pink, I don't know, something like that. So S&P 500, SCHD, and this is the total return, right? So total return is you take the capital appreciation and you take the dividend, right? The dividend reinvested. So the reason why it's important that you look at the total return is if you go to a website like Yahoo Finance or Google Finance and you type in the tickers here, so QQQ, SPY, and SCHD, you will notice that you're going to see different numbers, different percentages. And so you're going to see here that the Schwab SCHD is at 70%, the Spider SPY is at 68%, and then Invesco is just under 119. But this is only sharing or showing part of it, right? You have to look at the total return whenever you're comparing any investment because the dividend is part of the total return, okay? And so if you do that and you compare it with the total return, you'll notice that SCHD is actually outperforming by a higher margin than the S&P 500. And QQQ, let's see here, let's go back and forth. So QQQ here, the total return is 121. QQQ, the total return is just under 119. S&P 500, 68. S&P 500, 84, right? You see that? Look at that. Total return of S&P 500, 84 with the dividend reinvested. Here it's 68%. And now with the Schwab SCHD, look at this. 70% here without the dividend, and then with the dividend, 99%, right? You see that? Pretty cool. So with the dividend reinvested, the SCHD is actually outperforming the S&P 500. So pretty cool, pretty cool. Let's update this and let's see if we can see this at a 10-year glance, just because we can and we want to look at numbers and we have nothing better to do on a Sunday afternoon. But let's see here. Look at this. Even over a 10-year time period during a massive bull market, SCHD is outperforming the S&P 500. Isn't that incredible? The Qs are kicking some butt. I think you know, this is like the Bulls during the 90s. Michael Jordan just crushing everybody. And yeah, no, this is really cool to see. But what I will say is, you know, you have that reversion to the mean. I would not be surprised as we continue down this bear market that we see these kind of come closer together over the next couple of years. I would not be surprised one bit as the Fed is tightening, as money becomes less available. I can see growth, you know, compressing, and I can see the PEs for these different indexes going down. So right now, the PE for the Qs is just over 30. Okay, I'm really interested in this. Let's do this together. Let's see here. If you want to find the PE ratio for the ETF, for the weighted average, here, let me show you this right here. So the weighted average ratio of prices of fund stocks trailing earnings of underlying stocks. So as a whole, the weighted average, the Qs have a PE ratio of 32. That is still pretty high considering, you know, interest rates are continuing to go up. Let's see what the S&P 500 is at. S&P 500, wow, it's only at a 23 PE. So interesting. What is SCHD? All right, let's see what SCHD is. SCHD is just over 15. I really, really like that. You know, if you're a value investor, the PE ratio matters. This absolutely matters. And so what I could definitely see happening if we continue to go down this long extended bear market, it's not unreasonable to assume that the Nasdaq, that PE ratio is going to go down. It may go down into the 25. I mean, heaven forbid, it might be, if it gets really, really ugly, I mean, it might even get into the 20s, like low 20s in terms of the PE ratio for the Qs. So over 30, just over 20, around 25, mid 20s, and here 15. Absolutely incredible. Let's take a look at the dividend growth rate here of the 3 ETFs. So you got QQQ. Dividend growth over the last 10 years has been okay. It's been pretty stable. When I say okay, let me explain what I mean by okay. It's been, in terms of consistency, it's okay because they've gone down a little bit, right? You had two years in the last 10 where you've seen a decrease in the dividend. So that's what I mean, okay. In terms of the growth rate has actually been pretty dang good. You look at the annual payout growth, so the annual growth of it, right? So here, this right here, the negative 23, 24%, that's this that you see right here. And this right here is what you're seeing right here. But, you know, annualized over the last 10 years, it's actually not bad. And this is something that I really like to look at. If I would have invested in 2012, let's say I invested $10,000. Today, you know, fast forward 10 years, on that $10,000, it would be yielding me just over 8%. And this is just the dividend, right? The dividend that I would be getting on that. Okay, so pretty interesting. Now let's compare it to the S&P 500. The S&P 500, I like it a little bit more when it comes to dividend growth, right? You've actually had dividend growth, if I'm not mistaken, every single year except, back here during the financial crisis, you know, more than 10 years. Yeah, you've had a decrease, and a decrease, but not too bad. But where the SPY kind of falls short is on the dividend growth. But one thing that you have to bear in mind, so this is important, that you can't just look at one of these, right? So you look at this, let's look at 2012, right? So 2012, if you would have invested that same $10,000, you would have of 7%. Now with the Qs, you'd have 8%, right? This is look, QQQ. Right? QQQ, 8% versus 7%. But this is why it's, and I shared this in my last video, you can't just look at one of these metrics. You can't cherry pick. You have to look at both. The reason why that's important is you have to look at the yield. And if you want even a better measurement of this, you'll want to take the average, not just, you know, any given day, which is the end of the year. If you want an accurate amount, this is what you do. If you want a true form of it, you got to look at this. This is what you want to look at, the average yield. But because whatever, we'll just keep it simple here. We'll not do that for this example. But you look at this, it's over 2.5%. The starting dividend yield at the end of the year in 2012. You compare that with the Qs, and you have half of that. Do you see that? So yes, you're getting a higher CAGR on the dividend, but you're starting at a lower rate, okay? So that's why it's so important. And this, tying this back into time horizon, it feels like I talk about time horizon on every video. You should take a shot every time I say time horizon. This is why time horizon is so important. You see this? This is it. Like, this is the magic thing. If you want to be a black belt in dividend investing, this is how you do it. I don't know why I used the example black belt. Do you want to be a ninja? I was thinking ninja, and then I said black belt. Anyways, this is why it's so important. If you're learning about dividend investing, this is the kind of stuff you want to understand. But this is only the tip of the iceberg. There's so many other things that you got to learn. You got to be aware of. You can't just cherry pick. Okay, let me make sure I'm saying this correctly. When you're looking at these different metrics, when it comes to dividend investing, the payout ratio, the PE ratio, the dividend growth rate, the dividend yield, all of those things, you can't cherry pick one component. You have to look at the whole picture, and that's why it can be a little bit challenging for some. All right, let's move on and let's look at the SCHD. SCHD is great. It's not only okay, it is great. It is best in class when it comes to dividend growth. It's best in class when it comes to the underlying companies in the index. It's absolutely remarkable. So let's take a look at 2012. 2012, it's winning on the 12%, right? So let's do this. I'm sure I'm going back and forth between all these screens, and you're probably like, Jake, slow down. Whenever my wife and I look at websites together, we're looking at stuff. She's like, slow down, and like screams at me. So, all right, QQQ is the 8%. The S&P 500 is 7%, and the Schwab SCHD is 12%. But here's the thing, is this right here. This is what makes it so amazing, is the dividend yield. The dividend yield is massive. It's huge, right? That's why I really am such a huge fan of SCHD, is you get the best of everything with this one ETF. I absolutely love it. You get the performance, you get the quality, you get the dividend, you get the growth, you get everything. So when I compare these three, each of these ETFs, they're a little bit different, right? And they're going to perform differently in different market conditions. These three different ETFs, SCHD, SPY, and QQQ, there can be different reasons for holding each one of these, right? There could be a world in which you hold all three of them. There could be a world where you only hold one. And that's what makes investing so interesting, is everyone's in a different, situation. But like if you're in your 20s, you could hold QQQ in, your Roth IRA, and you could just let it sit there for the next 20, 30, 40 years. You could hold the S&P 500 in your Roth IRA. Me personally, I hold the total U.S. stock market. So I hold VTI. It's very similar to, the S&P 500. You get a little bit more diversification, but yeah, you could do that. Or you could invest heavily into an ETF like SCHD and, accumulate enough shares to generate enough passive income, cash flow from the dividend, so that you could retire early, like my wife and I are doing. Here in the next, 1 to 2 years, we're going to retire from our day jobs, and we're going to live entirely off of our dividend growth portfolios. And we're going to travel the world. And until that gets boring, and then we're going to go do something else. But the key thing is, with our plans to reach FIRE through dividend investing, it all comes back to time. And really, we're buying our time by investing. And we're investing into high quality dividend growth stocks and ETFs. So yeah, I hope that this was helpful. I hope that you learned something new. And I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.